The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Will December be a month to remember? Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Katie Greifeld. A little bit, but we'll work through it. Let's go check on where these markets stand the first trading day of December, as Romaine alluded to. You can see the S&P 500 not certainly a gift for bulls right now, down about 0.5%. Really, you can see something similar happening in the NASDAQ 100, where all your big tech names live. I thought it was interesting to see that the bond market not getting any sort of haven bid right now. We know there was a sell-off overnight in Japanese debt that seems to have filtered through into the U.S. market as well. 10-year yields higher by about 8 basis points. And Bitcoin, Romaine, keep your eyes on Bitcoin, down another 6.7%, sitting at $85,000 a coin. Just fascinating to see where this thing will go. Yeah,
I can't take my eyes off it. Katie, I saw a stat earlier this morning showing that the S&P has rallied more than 70% of the time in the month of December, but day one of this December, not showing signs of life just yet. Clear risk aversion wafting through markets, belying that 5-day rally we had to end November, a rally that now appears to have been more technical than fundamental, a clearing out of bearish options that drove a bit of a squeeze higher in equity prices, a clearing out that may not have actually completely run its course and won't until the Fed's meeting next week.
So I think some of the position unwinds are maybe not sort of fully baked in, but then to see a bit of a rally, particularly after the Fed meeting, which is sort of that near-term moment of uncertainty that has been part of some of this recent volatility in the market, it wouldn't surprise me to see another year-end pop.
That potential pop, though, is going to be heavily dependent on the volatility of other asset classes. U.S. Treasuries sliding today in sympathy with the bond sell-off in Japan, Katie alluded to. Added pressure also from concern about Trump's rumored pick for Fed chair, who could prove too dovish. For the moment, with inflation stuck above target, the dollar remaining weak, silver at a fresh record, and as Katie just pointed out, the ground beneath Bitcoin continuing to quake. $1 billion of leverage positions liquidated in crypto overall this Monday alone. As for the AI trade, that's also stuck in a bit of an air pocket. Bank of America strategists citing investor concern about that $500 billion or so in CapEx commitments, including how a group of asset-light, nearly debt-free software companies have now morphed into an asset-heavy, cash-draining, debt-laden business models. A Kafka-esque metamorphosis, if you will, that suggests a more meaningful de-rating, potentially, Katie, in AI stocks.
So a lot to keep your eye on, but let's go back to seasonality, because as Romaine mentioned, the S&P 500, it tends to rally more than 70% of the time in December, but take a look at the monthly performance. Actually, over the past 10 years, the S&P 500 has averaged about 0.1% decline in December, which really speaks to the overall volatility that you tend to see in the final month of the year. Of course, seasonality is no clear guide to the future. I'll point out that you take a look at November's performance. Typically, you see a rally of more than 4%. We know that the S&P 500 was barely positive last month, Romaine. So we'll have to see what history, whether or not it's actually a guide for this December. But as you mentioned, certainly the start of this month not looking too hot.
Absolutely. Joining us right now is Nguyen, CEO of Equities over at Research Affiliates, kicking us off to the close. And Nguyen, one interesting thing about this whole seasonality thing is when you look at past Decembers, very few of them had the type of run-up lead into the month that we saw this year. And I am curious about this idea of a market that it basically seems to have priced in so much of the future good news, if you will, and whether that kind of sets us up, not necessarily for a fall, but a bit of maybe a stasis or a tight trading range going forward.
Sure, there's a lot of fragility baked into markets because they are really dependent on a couple of things. The first thing being lower interest rates, and yet what we've seen is that the Fed seems somewhat divided on whether or not there'll be a rate cut in December. And the second is really just this whole AI story. How long can that go? How much further can that go?
Well, let's talk about the AI story, though. I mean, it's not, I don't think the AI story has sort of faded, but it's certainly morphed into something a little bit different. And I do wonder if the AI trade itself has sort of lost steam, or it's just that there's a rotation away from some of the big stocks that sort of got us to this point into whatever people think the new thing is going to be.
Definitely there's some of that, but I also think people are just sort of taking a breather. What they're seeing is that these big companies, they're spending a lot, they're investing a lot, they're actually issuing a lot more debt than they have ever done before, and they're just trying to reassess who's going to be the winner, who's not going to be as big a winner. Not everybody can be the big winner of AI.
Well, you heard Romain mention that note from Bank of America with strategists talking about those investors concerned around the fact, as you mentioned, that a lot of these tech companies are taking on a lot of debt to fund these commitments. You think about some of the blue chip names there, specifically Amazon, for example, comes to mind, and they probably have the capacity to do that. But I wonder how you think about that as, you look outside of the top 7 largest companies.
Well, the top 7 largest companies are the ones that are driving the investment. And so they all have, well, not really the 7. You have to take out Tesla, you have to take out, some of the smaller companies. But, those 5 or 6 companies, they have fortress balance sheets. They definitely have a lot of capacity for debt. And a lot of them are investing with demand in mind. Mm-hmm. I mean, you see Microsoft talking about how they just can't fulfill all of the demand that they see, and they need to make this investment. So the way I think about it is that, these companies are probably okay, but the question is what happens to, the second tier players that you see. And some of those stocks, they're beginning to participate. They see a lot of pressure to also invest. When you see an HPE, for example, or Oracle even, they don't have nearly as much of the strength as the Mag 7.
Yeah, absolutely. Oracle and what we're seeing in their CDS certainly comes to mind here, though. So, when it comes to the equity market, how do you invest around this? Because I'm taking a look at your notes, and you mentioned that the signs of a building bubble in AI, they're easy to identify, but the popping of that bubble, super hard to time. So what's an investor to do in an environment such as this one?
So the way we look at it is that, yes, the markets are rich, but they're not nosebleed levels. They're not what we saw in 1999. So it's hard to time. You don't really want to miss it. I think it's actually okay to own the Mag 7. These companies have magnificent earnings, they have magnificent balance sheets, and they have magnificent growth. They just probably shouldn't be 40% of your equity portfolio, right? So look outside of that, diversify into something that is less Mag 7 heavy. You can find great bargains in value stocks. You can find great bargains in small cap stocks and also non-US stocks. A lot of high quality companies that are going to be participating in growth.
Also on the AI trade, but particularly when it comes to some of those other stocks, there's this idea that people are now trying to seek out sort of the beneficiaries of AI, not necessarily the folks who are selling AI tools, but the idea of those that will be using them and presumably would see some sort of productivity improvements or cost improvements, et cetera.
Yeah, sure. I think that businesses are only just beginning to really tap into that, really experiment with it, really figure out what's working and what's not. And whatever works for businesses, whatever helps businesses improve their productivity, whoever provides those tools, they're going to be big AI winners. And the businesses that use those tools themselves will also be big AI winners.
And I do also want to ask about small caps. That's an area you identify in your notes as well. It feels like we've heard a lot of bull cases for small caps in the past couple of weeks, but how can you be sure that this current bid that we're seeing, this performance that we saw in November, is something that can be sustained in 2026?
That's always a big question with small cap, right? But I think that if you approach small cap in a very selective way, we don't necessarily advocate owning all the small caps, but find the ones that are relatively inexpensive, find the ones that have strong quality metrics, and those tend to be good long-term investments.
All right, Quay, always a great conversation. Nguyen, CEO of Equities over at Research Affiliates, kicking us off to the close here on this Monday afternoon, the first trading day of the month, the final month of the year, and a big deal here on Merger Monday. A conversation with Bryon over at Goldman Sachs Asset Management and a big ETF acquisition, Innovator Capital. That conversation coming up in just a second.
And from markets to markdowns, we're giving you a full Black Friday postmortem with the CEO of Klaviyo and Shor of Columbia Threadneedle Investments. We'll discuss what rang up, sold out, and fell flat for shoppers this weekend. And
Greg Schwartz, the CEO over StockX, he'll have some thoughts on that as well. He'll be stopping by to discuss the recent resale rush and where he's seeing the rarest drops and biggest bids. All that and more coming up here on The Close. This is Bloomberg.
Goldman Sachs bolstering its ETF operation, inking a deal with Innovator Capital to buy the buffer fund issuer for $2 billion. Now, buffer funds are also known as defined outcome ETFs, and they're really meant to limit downside risk in exchange for capped upside potential. Let's discuss this deal with Bryon Lake. He is partner, chief transformation officer, and also the global co-head of third-party wealth over at Goldman Sachs Asset Management. Bryon Lake, it's great to see you.
Those are a lot of titles, by the way.
Thank you for having me. Yeah, no, you know what I mean. Like,
I'm sure there's a few
I try to
more.
turn the lights off when I go home at night. That's kind of my job.
Well, let's talk about this deal. Certainly caused a lot of ripples in the ETF industry. And I guess my first question for you is why buy Innovator Capital? It's $28 billion worth of buffer ETFs versus try to build this out at Goldman Sachs in-house.
I mean, you know, so much credit goes to the team at Innovator. They invented this space back in 2018. They invented defined outcome ETFs. I mean, they have a history of innovating in this space. So they build out this business, they invent the space. Over the last 7 years, they've been able to scale the business to be $29 billion. But in addition to that, they have a full suite of products that cover all the different horizons that we see across the defined outcome space. Plus, they have an incredible team, 70 individuals that are extremely talented at talking about these sophisticated strategies, working with clients and articulating these to investors and showing them how they can use them within their portfolio. So when you bring all of that together, it just makes so much sense to add it onto the platform that we have.
And let's talk about the price tag a little bit. So $2 billion, for that you get $28 billion of existing AUM. I was taking a look at the reaction piece from Bloomberg Intelligence. That's about 7% of assets. That's probably closer to private market deals than traditional products. So show us the napkin math of how you justify a $2 billion valuation.
So over the last kind of handful of years, I've been traveling around this country working with clients. And in more conversations than not, defined outcome ETFs were coming up. How do I get more income in my portfolio? How can I get targeted downside protection? What about different growth areas that I can get within my portfolios? And over time, you start to notice this pattern. There's more and more investors that are looking for better ways to build portfolios on behalf of their clients. And so when you take that, you start to see, like, wait a second, there's a massive trend here. Now, Cerulli put out research last week. They suggested the space could grow 4 to 5x over the next 5 years. And so I don't think I'll get into the napkin math, but what I will tell you is that I know investors are really excited about the strategies. You've seen it grow massively over the last 5 years, and groups like Cerulli projecting 4 to 5x growth over the next 5 years. You start to see why we're so excited about this space.
Who specifically, in terms of the end users of these funds, who specifically are those types of people? I mean, that we're talking about. Are they using this primarily as a hedge, or is this actual real sort of growth and or income opportunities, I should say?
It's a great question.
Yeah.
So step back for a second. We called it defined outcomes, which is a pretty wide space. We see income in this category, we see targeted buffer in this category, and we see growth in this category. There's a lot that's going on there. So we've seen everything from core replacement. You know, I was using the S&P 500. I want to swap that out with something that could provide a little bit more protection. We see it as an income play. I want to put this into my portfolio and it can enhance the income that I have. We see it as a bond replacement in some areas where maybe I can use this instead of bonds and it gives me a little bit more equity upside. There's also some differentiated ways where, you know, investors are starting to use this to put cash to work. Markets are still at kind of close to all-time highs. And so, you know, if an investor is starting to put money to work, do you do that right now? Or maybe this is a great way to start to leg your way into an equity position without taking on some of the downside risk. And so I think that this is going to absolutely change the way that we think about portfolio construction over the next 5 years. We're seeing this both on the retail side and on the institutional side. Institutions have been using strategies like these for a long time. Now that we can deliver them through the ETF wrapper that is intraday liquid, that is transparent, that is tax efficient, that comes at an attractive price point, that starts to be a real game changer for us.
For the individual investors, is there sort of an education arc that's needed, at least if not for them, certainly with the advisors that are selling it?
Yeah, absolutely.
Yeah.
And you know, that's another big part of the Innovator team. I mean, they're experts at having those conversations, and we really want to embrace that. I mean, we want to lead with solutions. We want to lead with, this is how these are going to work within your portfolios. It's important that you own it point to point. There's different ways that these are going to move out there, but once you understand how those work, then you can really enhance what you're doing within your portfolios.
So this news in and of itself is exciting, but the natural next question, Bryon, is what's next? I mean, could we go out and see GSAM buy more companies, more areas in terms of white space where maybe GSAM doesn't have that presence?
So let's think about what happens with a transaction. You really need to get some things that are very aligned. First of all, when we think about Goldman Sachs and Innovator, our firms have very similar cultures. We wake up client-obsessed every single day. If you talk to the founders of Innovator or any person over there, they wake up thinking about the clients. When you talk to anybody at Goldman Sachs, we wake up thinking about our clients. So that's number one. Number two is Innovator has developed this space, like we talked about earlier, that is differentiated across anything else in the market right now. And so it's bringing differentiation to clients, which is something that Goldman's focused on as well. This fits perfectly alongside our direct indexing capabilities, our evergreen alternatives capabilities, and indeed our organic active ETF strategy as well. And so when you combine those things, it becomes really special. Now, that's a pretty high bar. And so to think that we're going to be able to find something else like that out there, I don't know. We'll look, but we're really confident in our organic strategy and what we're doing right now.
And just a fun fact, it's probably worth pointing out that, of course, you know the co-founders of Innovator well. Bruce Bond, I believe, gave you one of your first jobs at PowerShares. Yeah,
Bruce hired me into the industry a number of years ago. I think I was the 12th employee at PowerShares. And, you know, he's got an incredible track record of, you know, hiring good talent, myself aside. He's built some really good talent there. He's innovated in this industry for years. He brought the first smart beta strategies before we even called them smart beta. And this is just another one of those things that he and John Southard and the rest of the team over at Innovator have been able to accomplish. And, you know, so that's why we feel so aligned, that existing relationship that Goldman has had with Bruce and the Innovator team, and so coming together, we feel really good about that. You know, obviously we're bringing on all 70 of the employees to be full-time Goldman Sachs employees. We don't plan on changing anything as far as their sub-advisors or some of their service providers. We're just providing a massive tailwind to this business because we think the growth over the next 5 years and beyond is going to be absolutely explosive.
All right. Well, it's interesting to see the evolution, kind of what they built there, and what you're the baton that you're taking up, Bryon Lake, their partner and chief transformation officer at Goldman Sachs Asset Management. When we come back, we're going to talk about the battle for Warner Brothers Discovery heating up as the parent company of HBO and CNN, asking potential buyers, those deals you put on the table, you need to sweeten them just a little bit. That conversation coming up after the break. This is Bloomberg. Time now for our top calls, the big movers on the back of analyst recommendations. Let's start with Beta Technologies. Analysts initiating coverage on the electric aircraft maker that went public just last month. Morgan Stanley among the chorus, starting coverage with an overweight and a $34 target. The analysts likening Beta to a, quote, young Tesla, but with a more attractive end market in aerospace. That stock today actually down for the 10th time in the past 19 sessions since it IPO'd. Next up, Toast. BNP Exane upgrading the retail payments platform to outperform with the price target of $40, saying despite rising competition, Toast can actually still grow in its core U.S. restaurant market. Those shares up for a third straight day. And finally, Zscaler. Bernstein downgrading to market perform and setting a price target at $264, saying Zscaler's luster has worn off due to uncertainty around growth persistence. Those shares, though, looks like they're down about 3% here on the day, and those are some of our top calls. Let's turn now to Warner Brothers Discovery. Keep an eye on their shares as the media heavyweight said to be awaiting sweetened offers for that deal to potentially buy the company out. Jason Bazinet joining us right now to talk a little bit more about it. Managing Director over at Citigroup. Jason, we've seen some of the bids already, or at least we've seen reports of some of those bids. Do you think we're going to see a meaningful increase in those bids this week and beyond?
Well, I think it depends how you define meaningful. I think we'll probably get a few extra bucks. That's my guess. I mean, this is a very scarce asset. It has some very attractive assets that would help a lot of these companies. And so I think you can probably add a few bucks to the likely outcome if you're a Warner Brothers shareholder.
Well, Jason, I like the way that you broke down how to think about the potential suitors here in your note. You know, there are nice to haves and there's must to haves. So you think about the cast of characters that we're talking about. Paramount, for them, this is a must have acquisition. Talk to us about why.
Well, going back to 2019, we saw quite a bit of media consolidation. And I don't think there's been enough consolidation that's allowed any of the incumbent media companies to really take on Netflix. What Paramount Skydance did is it sort of, I would describe them as being sort of half pregnant in the DTC space. You know, they're not subscale relative to traditional media, but they are subscale relative to Netflix. And what the buy side's been clamoring for is another round of consolidation to hopefully give somebody enough oomph, enough content spend, if you will, to have enough content on that app to keep churn down, keep gross ads aloft, to begin to drive towards what I call the true pay TV substitute, which is what Netflix is. All the other DTC apps, whether it's Paramount or Max or Peacock, I just think of them the way consumers thought of HBO in the old linear days. You know, you go on for a particular show and you watch that show and then you churn off. And that's the world most of these DTC apps are in. They need to get enough scale to become a true pay TV substitute.
Well, that gets to the idea, too, of like who ends up winning this. I mean, to a certain extent, I look at Netflix and I think, why even go through the hassle? And then I look at Paramount, Jason, and I just want to be honest here. Is there any realistic possibility anyone gets this other than Paramount? I don't mean just on price, but given the connections to the Trump administration and obviously the antitrust regulators that would have to sign off on this deal, I would think they would have a serious leg up over the other potential bidders.
Yeah, I think that's true. I think, you know, I don't think any of these potential suitors have insurmountable regulatory risks, but I think it's certainly going to be easier for Paramount to get the deal done with less regulatory review. I think what it comes down to is you could face a possibility where Warner Brothers shareholders, you know, or the board opts to sell for a smaller premium with a greater likelihood of sort of the deal going through relatively easily. That I think is certainly possible. I've seen it in the past with other deals where they've sold, where they've accepted less than the highest bidder because of lower regulatory risks.
Yeah, it'll be interesting to see how this shakes out. Jason, we only have about 30 seconds left with you or so, but let's quickly talk about what sort of premium we could be talking about here. Warner Brothers shares right now trading just below $24 a share. What do you think that ends up?
Yeah, I think we've sort of penciled in going back to early October, 23 to 28 is probably the range where we come out. The reason it's a wide range is we did the normal customary premium. We did the share in the synergies that we anticipate, which is about $3 billion a year. And then you get into this X factor of what is the scarcity value of the asset. And that we think that can range from $2 to $6. And so when you put all that math together, if you have a low scarcity premium, you end up at 23.
Right.
If you end up with a higher scarcity premium, you get up to 28.
All right, Jason, great to get some time with you. That is Jason Bazinet, Managing Director over at Citi. Coming up, it's all about Black Friday. This is Bloomberg.
Friday was another record-breaking Black Friday weekend. We saw about $6.2 billion in sales for Black Friday. That's up about 25% from last year. We saw peak sales of $5.1 million per minute on Friday. That happened around noon on Friday. That's up from $4.6 million last year as well.
The president of Shopify speaking on Bloomberg earlier today about the, quote, record-breaking Black Friday sales here at 3:30 p.m. in New York City. And Katie, I don't know if you had a chance to look at some of the sales stuff, but when you see these numbers, I mean, there's two issues. First question is, are they inflation adjusted?
Right.
But also, like, what are we really talking about in terms of sales? Are people really going out there and buying gifts, or are they just buying for themselves? What's the complexion of the spending?
That's the big question, right? Behind the dollar value alone, what actually are people buying? And what does it say about the state of the economy? I will say it's interesting with Shopify. You can see shares down nearly 5% right now, as we heard. Record-breaking Black Friday for them, but that 25% growth in merchant sales that they saw actually lagged the consensus expectations. So you pile on high expectations on top of that, and certainly there's a lot to sort through here.
Yeah, absolutely.
Well, let's keep this conversation going now, because according to Bloomberg Intelligence, Shopify is Klaviyo's largest platform, representing close to 80% of annual recurring revenue. And joining us for more on this and the overall health of the retail and payment space, I'm pleased to say, is Andrew Bialecki. He is the CEO over at Klaviyo. Andrew, great to have you with us. So give us some color. What did you see on Black Friday? And not just Black Friday, the weeks preceding it, and of course, the weekend too, which is lumped into that group overall.
Yeah, thanks for having me. So Klaviyo serves over 180,000 businesses around the world. We act as a CRM for consumer businesses. You can think of great brands like Glossier, Away, Mattel. And I'll give you three themes we've seen. So the first is, like you said, record-breaking. Through Klaviyo's platform, just on Black Friday, the businesses that we serve did over $1 billion in sales attributed back to our platform. That's the first time ever. That's up, like, similar to what you're talking about, about 25, 26%. And we're seeing an increase in repeat buyers. We've also had 20,000 businesses set a record on their best sales day ever on Black Friday, and I think we're gonna have a lot more set records today. The two other themes are we're seeing consumers really demand better experiences from businesses. So we're excited for brands like Beyond Yoga that are now using our customer agent so that when you visit that website, you can use AI to chat with the brand and help find the right product, whether it's for yourself or for somebody else, to fit a budget. And then the last thing is that the state of consumer is pretty strong. When it comes to discounting, we actually saw a lot of brands not discount as heavily early in the holiday season. And actually, instead, they leaned into, kind of more, interesting product drops. So, for example, Mattel, a great Klaviyo customer, they set up a member-first sale for some of their new Hot Wheels around the Stranger Things launch on Netflix, and that, sold through really well. So I think we're seeing that instead of discounting, people are also just using special access or special experiences to drive demand.
I'm curious, Andrew, with regards to the types of consumers that have been shopping, what's sort of like the conversion? I mean, so for example, when I go and shop on Black Friday, I see a deal. Am I going to the retailers and e-commerce companies that I normally go to, or am I going to a place maybe that I've never shopped at before and I've been sort of tantalized by, the % off that they're offering me?
Yeah, it's a great question. So we mentioned not quite as much discounting as in past years. Another thing is we're seeing a slight uptick. When we look at that, $1 billion in sales that businesses drove through Klaviyo on Friday, a lot of that is from repeat buyers. So we're seeing more repeat buyers. Consumers are going back to brands that they already know, whether they're shopping for themselves or a friend or a family member. Another thing is we're seeing buyers be more considered. So product views. So you think about the amount of consideration before people buy. That's up 37% year on year. So we're seeing a lot more browsing behavior. People are trying to understand products better before they're buying them. And then in terms of categories, we've seen two categories that have sort of paced the field this year. Health and beauty, so probably people shopping both for themselves and for others. That was up over 12%. And apparel was up almost 12% year on year.
Interesting. And I mean, I wonder if this fits into what we were hearing from the likes of Home Depot and Lowe's, that folks are less willing to spend on big purchase, big ticket items here. And you think about health and beauty in particular, it's often thought of as sort of an affordable luxury. Andrew, I wonder if that fits into that sort of narrative, or does that not quite match with what you're seeing across your categories?
We work with a lot of health and beauty brands, as well as some, home improvement businesses. I think a trend across all of them is, when folks are more budget conscious, they're looking for that brand to deliver more than just the products, but also a great experience. And that's why we're seeing a lot happen with AI. People are using AI now when it comes to marketing, for message personalization, say timing or content. And then I also mentioned on the customer service side, something that we at Klaviyo are happy to stitch together is they want businesses that know who they are. And so maybe if they are trying to fit a budget, they can find the exact right product or kind of maximize that value. Yeah. And they're able to do that now through conversational AI that's happening, with these brands. One of the trends we're really excited about is AI is both where people are starting their searches, say on ChatGPT and others, but it's also where they're ending their searches. They're leveraging AI that businesses themselves are providing and using that to decide which products to buy and make buying decisions in a way that just in the past, for most retailers, it was just whatever you find and you decide you want, that's kind of the end of the shopping experience. I think that's changing in a pretty dramatic way this holiday year.
All right, Andrew, great insights. Always appreciate it. Andrew Bialecki, the CEO over at Klaviyo. We keep the conversation going right now with Mari Shor, Senior Equity Research Analyst over at Columbia Threadneedle. And Mari, I am curious. I mean, we talk a lot about what consumers are spending and what they're willing to spend. I'm curious as to your thoughts how prepared retailers were for this holiday season, particularly given we spent all year long talking about tariffs and how that was going to disrupt supply chains and inventories and the like. Were they ready for this moment this weekend?
Yes, thank you for having me. I think the retailers were absolutely ready for this holiday and in fact positioned pretty conservatively into holiday. I think for the majority of the year, we've seen strength in categories like apparel and beauty that Andrew just spoke about. And even with strong current business momentum and strong Q3 results, all of the retailers took a very cautious approach into holiday. based on the anticipation of higher inflation from tariffs. So as they enter holiday, inventory and promotional levels are very healthy. And I think it's important to note they've seen a better than expected price elasticity from price increases they've taken to date. So I think, if anything, the retailers position maybe even a little too conservatively into the holiday, given the recent strength we've seen.
Well, that's really interesting to hear, Mari, the fact that maybe retailers are positioned a little bit too conservatively. Do you think that that's something we could see change over the next 4 to 5 weeks?
No, I do think the retailers are very focused on managing unit inventory levels in order to protect full price selling and margin. So I think that that behavior will continue into next year as well. But again, that's very supportive for both the top line and margin. And I think that that is a trade-off that the retailers are willing to make.
As you sort of try to assess how retail is going to sort of perform this month and really into next year, Mari, do you have a sense here of maybe who you think is going to do better than the others?
Yes, I think that we've seen better than expected results and pretty consistent trends for most of this year. There have been a couple blips, like in the month of September when it was much warmer, but overall we've seen continued strength in the online part of the business and categories like apparel and beauty. But when we think about really who the winners are in retail, I think about them in two buckets. On the one end of the spectrum, you have scale players who are offering value and convenience and are taking share. So I would put companies like Walmart, Amazon, Costco, TJX in that bucket. On the other end of the spectrum, you have brands that are executing incredibly well, that are offering great value and product. And within that bucket, I would put companies like Gap, Ralph Lauren, Tapestry, Levi, and we still think that among those two buckets, those companies will continue to take share as we move through this holiday and beyond.
All right, Mari, great stuff. Mari Shor, Senior Equity Research Analyst over at Columbia Threadneedle. A closer look here at the unofficial start of the holiday shopping season. When we come back, we're going to take a look at some of the big movers on the day. To the upside, not a lot of retailers out there. To the downside, not much there either, though you are seeing a huge downdraft in some of the vaccine makers. Moderna down 6%. It's our stock of the hour, and it's up next. This is Bloomberg. Time for our stock of the hour. We're taking a look at the biggest percentage decliner in the S&P today, and that is Moderna. The share is down after a warning that the FDA could enact new restrictions around which vaccines actually make it to market. Norah Mulinda joins us right now, our Bloomberg's markets correspondent. And Norah, this gets to the idea. We should point out Moderna, obviously most famous for that COVID vaccine. Remember COVID, right?
Yes.
And of course, they were trying to sort of branch out from that, but into other vaccines as well, like flu vaccines. What exactly is the FDA talking about when they say they could sort of limit what actually makes it to market?
And that's what we're trying to really figure out right now. It's really as we're digging into the actual specifics here. I mean, they are calling out the fact that they are going to be implementing some new restrictions. They talked about 10 children passing away due to myocarditis, if I'm not mistaken. But essentially, they're talking about the fact that vaccines are linked to a lot of things that could be potentially fatal, and that's what they're really trying to limit. They're saying that they're done with the rubber stamps. We're just pushing things through and getting them approved, and they're really wanting to be a bit more critical and scrutinize a bit more what these companies are doing before they make it out to the market.
Just to be clear, as somebody who's covered the FDA for years, including sitting through a lot of PDUFA meetings, I don't think I've ever seen the FDA rubber stamp anything, but that's just my 2 cents.
Fair point there.
Yeah.
You're on the ground reporting there. I mean, let's talk a little bit about what this means for the space as a whole. We're spending a lot of time on Moderna. Certainly the stock is down about very deeply today. It's 8% over the past 6 months, but this would theoretically affect other vaccine makers in addition to Moderna as well.
Absolutely. It would actually affect multiple names, not just Moderna exclusively, but that is what we are seeing in terms of a lot of the pressure right now, down about 6% as we look at Moderna more broadly. But as we really see about what the stock has been doing this year, we are seeing a lot of pressure. The stock is down more than 40% so far this year. And of course, we know that's because the company spent a lot of its time on the COVID-19 vaccine. For a lot of people that weren't familiar with Moderna, that's when they kind of became familiar with the name when they were thinking about vaccines for COVID-19. But because a lot of people aren't really going out to get those vaccines anymore, they're having to come with more creative ways to really stay profitable and to really entice, customers here in this environment. But not only that, but outside of that, we also have RFK Jr., who also has been coming in as the head of the HSS. And of course, that really has been putting a lot of pressure on the space more broadly because people see him to be a vaccine skeptic, somebody who's more critical of the space. And he's also putting a lot of people in charge that are also similarly like-minded.
Yeah, a lot of headwinds for specifically for the vaccine makers, but the industry overall when it comes to health and pharma. Bloomberg's Norah and Mulinda, great reporting as always.
Have you gotten a COVID shot?
I should.
I
have.
I got one a couple weeks ago.
Okay.
That's good.
I got a flu shot,
Maybe it's time for me to double back.
Perhaps. This is the close.
The markets are rich, but they're not nosebleed levels. They're not what we saw in 1999. So it's hard to time. You don't really want to miss it. I think it's actually okay to own the Mag 7. They just probably shouldn't be 40% of your equity portfolio, right? So look outside of that.
Nguyen over at Research Affiliate saying it's okay to own the Mag 7 and for good reason here. We talk about the cash flow, the profitability, the revenue growth. As a group, not doing much today, but of course they are the group that has got us to the promised land in this 3-year-long rally.
And to be fair, not much of anything is doing much today. The S&P 500 off by about 0.4% on the first trading day of December, off its worst levels of the session. Those were about 0.7% lower, but still going to end firmly in the red. The Nasdaq 100, where big tech lives, down about 0.3%. A sell-off underway in the bond market. We've been hanging out around these levels for a while, with the 10-year yield about 8 basis points higher.
And that is intriguing because remember last week, all the talk was about holding that 4% line, whether it would go back below that and stay below it, but obviously got to answer today. And I'm not sure what's going on with the coin called BIT, Katie Greifeld, but at one point, it's down below 84,000.
Yeah, something biblical, I think. Of course, we know that a lot of leverage has been flushed out. It's going to be really fascinating to see how that evolves through now, right now and year end.
As we count you down to the closing bells, I'm keeping a close eye here on the markets and a lot of questions about whether the rally is over. Well, just getting a little bit of a reset. Kim Forrest joins us right now, the CIO and founder at Bokeh Capital Partners. And Kim, it's kind of interesting. We were talking with Nguyen at the start of the show. She was actually making a case for kind of staying invested in that AI trade, though broadening out a little bit more. I think every day we come in, we get some sort of read on how much money is being spent. Earlier today, there was that whole deal with OpenAI, the NVIDIA Synopsys deal, a couple others that I'm forgetting. There's still a lot of money, and I'm talking about from company to company, being sloshed around in this space that I think would give investors maybe a little comfort that there is a little bit more life, some more legs to this trade.
I agree, although I don't think it's going to play out how everybody thinks it is. And I'm guessing what people think, but OpenAI seems to be the center of the universe, right? And their style of AI, the chatbot, the large language model, seems to be what we all think of when we think of AI. And I disagree with that greatly, because I think the large language model is a beautiful thing. You no longer have to figure out how to talk to your computer. You just talk to it like a person. You get an answer. You can, go back and forth, say no, fetch me this. It's much easier to use. But ultimately, I don't think that's where productivity gains really come from. They're going to be specialized products that target a really small problem that is really powerful. And we will need data centers for that. But I don't know that we need the vast amounts that people are banking on in the the OpenAI style of data center. So I think we're in a bubbleette, maybe? Mm-hmm. I made that word up. But not really a full-blown bubble, but just a misunderstanding. We'll put it that way.
Oh, you can coin that, Kim. And I am curious. It's funny, we talk about data centers, but we've seen an evolution of AI use cases, and more importantly, the investment case. And obviously, you started your career kind of in this space as well. And I am curious as to, when you look at the evolution, particularly from when you started your career working on some of these software models, and to where we are today, are we focusing on the wrong things? Because I know we always talk about chatbots and data centers as being the core of AI, and maybe it is, but is there something else out there that we should be paying attention to?
Yeah, we should. I mean, here's what the big conundrum is. I don't think people really understand what AI is. They got to feel it and interact with it. But at its heart, and I can see this whenever I use ChatGPT, it's really either optimization or pattern matching. So any kind of class of problem that uses that, pattern matching, or you need to optimize across many variables, AI can do it for you. And again, you could have these smaller targeted models that do much better than humans do. Let's just say something crazy like reading, X-ray films. People are good at it, but computers are probably better at pattern matching. So it's things like that where you teach them a really small thing as opposed to letting it wander the internet and learn whatever, right? I guess that's kind of what I see ChatGPT being.
Right. It's a good point that you think a lot of people, how they think of AI is basically chatbots that you talk to, but it's much more than that, obviously, Kim, as you point out. Let's talk about some of the big players here. We know that we got the news about NVIDIA and Synopsys today. NVIDIA basically investing in one of its suppliers. And I think that's interesting, too, when you compare the timing with what we learned from Alphabet last week or the week before. Time is a fuzzy circle. But when it comes to TPUs taking the industry by storm, I wonder what you made of that timing.
I thought it was really great. It really put OpenAI back into the, we're still, and NVIDIA, right? Mostly NVIDIA. We're here too. I thought that was really, really funny. And I bet not many people figured that out, that maybe NVIDIA really did need to be elbows out and reclaim its leadership spot by saying, look, not only are we doing great things and creating great products, but we have a forward path where we're going to use AI and make even better products than these so-called competitors. So yeah, I thought that was really kind of funny. Happy Monday, everybody.
Well, Kim, we only have about a minute left, but you talk about NVIDIA putting its elbows out, sort of reclaiming its place here. How long can they keep that mode, especially if TPUs really take off as a reasonable alternative?
I know. I don't know that they really should try to keep the leadership. They should try to be the very best NVIDIA they can be. And I think that will allow them to return shareholder value. God knows they already have. I don't think you need to be all things AI. You just have to be the very best at what you do. TPUs have a role. GPUs have a role. Why can't we all get along? But people are running these companies, and people really like being number one all the time.
Absolutely. The psychology of the markets and business. Kim, always great. Kim Forrest, the founder and CIO over at Bokeh Capital Partners. Meanwhile, we turn back to the broader market. Been on the back foot all day long with the S&P down about 0.6%, Katie. But you look at sort of the names that are moving here. Yeah, you have the majority of the stocks in the red, but you do have some very notable names that are kind of holding the line. The ones we care about, like the NVIDIAs and Apples of the world. Yeah, that's a very optimistic take that a lot of the big guys are still in the green, but you think about what... You are an optimist, you just radiate positivity. You think about some of the big weights on the downside, Broadcom, Microsoft, Alphabet, Meta, that's going to be hard to fight against, though I will note that volume is relatively low today on this Monday. Absolutely. A lot of people still on vacation. Maybe they're going to start to come back in just a bit. We're going to have a full breakdown of all of today's market action and what to watch over the next week. That's coming up now on our Global Simulcast.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick here with Katie Greifeld, taking you through to that closing bell with the Global Simulcast. There's Carol Masser and Tim Stenovic in the radio booth. Welcome to our audiences across all of our Bloomberg platforms, including our partnership with YouTube. Kicking off the month of December, Carol, on a bit of a down note.
Yeah, I mean, it's kind of just, I feel like malaise in the equity markets. What's really captured my attention, though, is what's going on in U.S. Treasuries. You've got that 10-year easily above 4%, but we've just seen yields tick higher, even though the expectations at next week's Fed meeting is that we're going to get another Fed increase. So a lot of it has to do with what happened in Japan overnight.
I thought you were going to say what really got your attention was what's happening in the crypto markets. I mean, Bitcoin's down another 6.3% today. Ether's down 8.7%. XRP down 7.5%. Bitcoin 85,300, off more than 30% from that all-time high.
Yeah, it is pretty stunning to watch what's going on in the crypto space, and it feeds into what's going on in the equity market. We have a lot of crypto equities out there. Strategy comes to mind, but also Robinhood, for example, and exchanges such as Coinbase. There's a lot of crypto exposure just in the public equity markets.
Absolutely. And then we take a look at just cross-asset wise, too, some other things for investors to keep an eye on. You see the weakness in the dollar, but also I thought it was interesting, too. You continue to see a lot of activity in the commodity space, that big run-up that we're seeing in silver, which seems to be, at least for today, at the expense of gold, and a lot of concerns right now about oil prices. They now start to creep up just a little bit here on this December 1st. We get the closing bells in New York on the first trading day of the final month of the year. The S&P lower by about 0.5% on the day. The NASDAQ indices each down by roughly about 0.4%. The Dow Jones Industrial Average down about 0.9% as we wait for these numbers to settle. But the Russell 2000, that's going to be your laggard on the day, down 1.3%.
All right, and let's go to the S&P 500, back there to the big caps, and we've got most names in the index lower today, Katie. 367 names in the S&P 500 losing ground today, 135 to the upside, 1 unchanged.
Yeah, similar story when you take a look at the circle. A lot of it is red today. You did see tech manage to finish slightly in the green. Energy was your big outperformer on the day. That sector higher by about 0.9%. But in terms of what was really dragging us down on the downside, utilities off by about 2.4%. Industrial is also a bit of a wipeout, off by about 1.5%. Healthcare, real estate, just some of the many losers today, Carol.
All right, let's get to some of the individual gainers, if I may, in today's session. And I'm going to go to Old Dominion Freight Line, because this one up as much as just shy of 6% at its highs today, but finishing with a gain of about 3.2%. We did see it among the top gainers in the S&P 500, the NASDAQ 100 today. BMO Capital Markets raising the recommendation on the trucking company to outperform from market perform, saying the company is set to, quote, deliver upside when the freight cycle turns. They did, though, lower their price target to 170 from 172, so just a slight adjustment there, still implying about a 26% increase from Friday's close before this call. Stock is still down roughly 19% year to date. Got to talk about Synopsys, right? Certainly a name that is your top gainer in both the S&P 500, the NASDAQ 100, finishing the day just shy of a 5% gain. NVIDIA invested in $2 billion in Synopsys as part of a broader engineering and design tie-up, according to the company, aiming to infuse its AI computing technology into more industries. So this new partnership involving integrating NVIDIA's tools into Synopsys's chip design applications, and the companies will deploy AI agents and work on joint marketing. So that circular financing, or just circular deals, it seems, maybe not necessarily this one, because I don't think that Synopsys has to buy NVIDIA chips, but nonetheless, it gets, not yet, right? It gets a little bit cozier. All right, DoorDash, got to mention real quick, 3.6%. It was a top gainer in the NASDAQ 100. This after Alfred Lin, a managing partner of Sequoia Capital Operations, the second largest investor in the delivery company, boosted his stake in the firm, according to a filing on Friday. And Leggett Platt, I have to just mention, Leggett and Platt. I know.
That's what you chose?
Up 16% in today's session. I thought that you would like that. I was assuming you might annoy me later.
What do they do?
What do they do? They're a betting company.
Oh, cool.
Yeah, they make. Well, actually, they're a supplier to a betting company. So Citigroup International proposed to buy one of its biggest suppliers, that being Leggett and Platt, and it's an all-stock transaction. So yeah, I'm done.
Bedding, bedding, not betting.
Bedding.
Bedding, not like betting.
Not like betting, like gambling.
Okay, just making sure.
You kind of took the wind out of my sails. I really thought you were going to like that one, Romaine.
She does it for you, Romaine.
Citigroup, Tempur Sealy, Mattress Firm, Dreams, betting businesses.
Romaine's not saying anything, so I'm going to go. The worst performer in the S&P 500 today.
Just a little wounded.
Moderna, down 7%. Shares of vaccine makers fell after Vinay Prasad, a top FDA official, said in a memo that the agency would place new restrictions on which vaccines hit the market. The decision has the potential to curtail which vaccines are available, and medical groups and public health experts have slammed the moves to limit vaccine access, saying they could put millions of lives at risk. Once again, Moderna down 7% today. MicroStrategy, or Strategy rather, as it's now called, MSTR is the ticker, fell only 3.3% today. And I say only because it was down as much as 12%. We saw a little buying late in the session. watching shares of the company on a day when we saw heavy selling of Bitcoin. Strategy did come out and create a $1.4 billion reserve to fund future dividend and interest payments, which will cover at least 21 months of dividend payments. Remember, this is originally a software company, and the software business doesn't generate enough free cash flow to cover the dividend or interest payments, and Bitcoin doesn't pay a dividend. So the question is, where would that money come from? The company's shares slumped due to concern that it may be forced to sell some of its Bitcoin holdings if token prices continue to fall. And finally, looking at ADRs of Airbus today, the plane maker based in Europe, down 3.2%. The company did reveal a quality issue on some fuselage panels of its A320 jetliner just days after flagging a software glitch on about 6,000 of the jets. This is the workhorse. This is the moneymaker. It's the competitor to the 737. George Ferguson over at Bloomberg Intelligence told us that the company could have a problem meeting earnings goals as a result of these challenges, but doesn't think that anyone's going to actually get out of the line, which extends just around a decade to actually get one of these A320s. So doesn't see long-term impact on the company as a result of this.
All right, meanwhile, we do have some breaking news in the form of earnings from MongoDB. Here's the headline. Third quarter adjusted EPS beats estimates, coming in at $1.32 a share. For context, the estimate was for 80 cents, so quite a beat there. You can see that reflected in the shares. The third quarter loss per share was 2 cents. The estimate had been for a loss per share of 13 cents, or rather that was the year-over-year number here. When it comes to third quarter revenue, that came in at $628.3 million. The estimate had been for $594.8 million. So a big beat there on several measures. And you, again, can see that in the shares really extending now up about 12% after hours.
Yeah, kind of interesting to see how this company, the stock at least, I should say, has kind of gotten its mojo back the last 2 or 3 earnings periods here. You're seeing a big pop there in the shares in the after hours trade. Meanwhile, let's just check in on treasuries because we did see the entire yield curve shift higher on this Monday afternoon. It was largely a function, first of all, of that sell-off that we saw in Japanese debt because of concerns about inflation, that then sort of fed into the U.S. because of concerns about Trump's rumored pick to lead the Fed. That raised concerns about inflation, and you saw those yields move higher. Also, don't forget, you got a huge deluge of corporate borrowing that's crowding out some of the money that would normally potentially have gone into treasuries.
All right, good stuff in terms of what we're seeing for yields and treasuries. Hey, let's go to some stories that have jumped up on our radar. This one caught our attention, and this has to do with kind of even the Magic Kingdom being concerned about the power grab that's going on with all the data center build out. Disney seeking energy trader as big firms try to curb power costs. So they're basically looking for an energy trader as major corporations are growing more shrewd about controlling their energy costs. And we kind of have seen this, I feel like, with fuel and different things in the past, but it's
yeah,
getting
like an airline
steeper.
does when it hedges fuel.
Exactly.
Some airlines do that. In case you're interested, the successful candidate will buy power on an hourly and daily basis, secure favorable pricing, and help keep one of the world's largest tourism destinations reliably powered. So for all the Disney adults out there who may be interested in the power industry as well, this job's for you.
Wow. You do need 5+ years of wholesale electric market experience, but this has to be the dream job for someone.
Do you have to like dress up in a costume for this?
Wear the ears, perhaps? I'm not sure.
Mickey Mouse, maybe?
What else you got?
That's what we got.
Oh, that's
what else
we
you got?
Well, I've been keeping, well, I don't know, Katie. What are you doing?
So
I'm trying to protect my voice here. Anyway, the one big story that we've been following here, just being joking around here, is this big casino approval that we have in New York City. Of course, New York City proper doesn't really have traditional casinos. 3 got approved today, including one that will be developed by Steve Cohen, of course, a former hedge fund manager, now the owner of the Mets, who's really kind of building out a whole sports and now gambling empire out there in Queens, New York.
Yeah, this is an
That's where the nanny's
one.
from.
So the other 2
Kevin
projects
James.
selected are...
Queens get the money.
I mean, what year is it?
I thought you were
I don't
saving your voice.
Nice.
Apparently, it's also expanding next to Aqueduct Racetrack. I do think this is really interesting. And also, what doesn't Steve Cohen do? You think about this empire that he's built, adding, casinos to it as well. It's pretty fascinating.
I'm just glad they didn't build this thing in like Midtown Manhattan like there originally. Like Times
Not in your
Square.
backyard.
Like, have you been to Times Square? Like dropping
to.
a gigantic casino there, I can guarantee you it would have attracted the wrong kind of people.
Yeah, it's kind of amazing though to see it even close nearby. All right, guys, that is a wrap.
Are you not a gambler?
I'm not. Are you a gambler?
Never.
Okay.
Don't touch it.
That checks.
I heard the house always wins.
That's what I heard. That's why they have the businesses. All right, guys, that's a wrap. Our cross-platform radio, TV, YouTube, Bloomberg Originals. Katie and Romain continuing there on the close. Tim and I continuing on Bloomberg Business Week Daily. We'll see you again, same time, same place tomorrow.
As we wrap up the day, the cash session for public markets, we turn our focus to what's going on in private markets. A discussion on credit concerns with Robert Cohen, the Director of Global Developed Credit at Doubleline. That's coming up next here on The Close. This is Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Katie Greifeld.
And I'm Romain Bostic. An interesting start to the month of December. Traditionally a month where we do see stocks rise, but a bit on the back foot today. Some caution, if you will, a bit of a decline in risk appetite. The S&P 500 down about 0.5% on the day. The biggest drops that we saw, at least amongst the major indices, that was with the Russell, which closed down more than 1%. Also, a lot of activity right now in the yield space, that entire curve shifting higher, believe it or not, despite a lot of expectations for rate cuts. Some concerns here about the balance here between what's going on in the labor market and what's going on in inflation. Meanwhile, risk sentiment remains subdued, partly because of the downdraft that we continue to see in Bitcoin. But if you're looking for any bright spots here, you take a look at silver, up right now, 57.95. We'll just round it up to 58 and change right now. Katie Greifeld, that's a record high.
Well, let's take a look at some of the individual equity movers that were really moving and shaking the indexes today. We start with Moderna. We were talking about this a little bit earlier. The top FDA official sending a memo. Perhaps we're going to see vaccine restrictions coming. Moderna shares down 7%. We've also been talking about Bitcoin. You saw it, of course, on Romain's board there. That's hurting crypto-linked stocks, that big downdraft that you're seeing in cryptocurrencies. Robinhood shares falling about 4%. But on a bright note, Synopsys shares rising nearly 5% after NVIDIA, which of course Synopsys supplies to, said that it would invest in about $2 billion worth of Synopsys stocks. Now that brings us to our top story this hour, and that's big tech's AI debt wave threatening to swamp credit markets. Issuance, as we've been discussing, has been on a tear this year, setting an annual record of nearly $6 trillion. Wall Street underwriting to fund AI and data centers soaring, with recent bond offerings from the likes of Alphabet and Meta. Now, Morgan Stanley expects that tech firms will float as much as $1.5 trillion of debt by 2028. Romain warning that could widen spreads across the entire market.
All right, well, let's get some insights out of somebody who knows a lot about this. Robert Cohen is Director of Global Developed Credit over at Doubleline. And Robert, I am curious about this. I know a lot of people are fretting about some of the recent borrowing that we've seen as people sort of chase these AI dreams. But we'd be remiss in not pointing out that, at least so far, the vast majority of these borrowers are coming into this with incredibly healthy balance sheets by pretty much any metric that you would normally see. Does it give you concern at all about the level of borrowing or the type of borrowing that's being done?
I think the borrower matters. You mentioned that many of these are from very high quality companies, so Alphabet, Microsoft. But spending money on data centers isn't really a problem. Oracle's balance sheet, on the other hand, has been increasing in debt, and they've gone cash flow negative. And then as you go down the credit spectrum, you start to see more and more speculative borrowing. And the market's pretty much figured this out. The risk tiering is pretty efficient. So investment grade credits yield, high fives to maybe 6 for credits in the AI space. And then in high yield, you see anywhere from high 6s to over 10%. Yeah. And so it really depends on how close you are to one of these so-called hyperscalers. Mm-hmm. For credits that are well supported by them, spreads are tight and their credit risks are relatively contained. When you are on your own without the support of one of the major players, so-called hyperscalers, you become a lot more speculative, and you see that in the spreads that the market demands for those credits.
Well, I'm curious, so given the uptick in activity, and obviously you get paid a lot to sort of sift through all of this, separate the wheat from the chaff, if you will. But the big theme, certainly in public markets all year long, has been AI. To a certain extent, it's been M&A activity, and that, of course, is also the big theme that we've seen, at least in the second half of the year, with regards to the credit space. Does that continue through 2026?
Oh, I think the party just got started here. We've gone through a period of basically credit creation being in decline, meaning that the amount of credits have actually been shrinking. Corporate credit has been in decline, really across fixed income. The size of the markets have been in decline. Now we're seeing an uptick. M&A has been below trend since the pandemic. And I think this is really just the very beginning. So while people are pointing to a few transactions here and there, I think 2026 is going to look a lot different, where we have growth in M&A and growth in credit creation. And so there's going to be a lot more to see as we turn the page into next year.
Well, looking forward to next year, one of the points that you make in your notes that you sent over to our producers is that you would expect that credit returns could be competitive with equities next year. Robert, that feels like a big call. Does that say something about the equity market, perhaps in a downdraft, or does that say more about credit really outperforming here?
Well, if you take out AI, it's not a big call, because the S&P equal weighted is up about 10%. High yield corporates and investment grade credit are nearly tied at about 8% total return for the year. So you gave up, if you didn't buy the S&P equal weighted and you bought high yield, you would have given up 200 basis points, which is something, but not a whole lot given the volatility differences. And so the point being, if you strip out all the AI stuff, the returns aren't that different. And I think next year, the story about equities broadening out, the returns being from more stocks beyond the Mag 7, I think that could, if that ends up happening, you'll have a diluted sort of return profile, let's say high single digits. That sounds like something you could do in credit. So volatility adjusted, I think equities versus high yield or some forms of credit seems very attractive. If you think about the fact that we could certainly have volatility next year. People forget we're ending the year pretty well, but we had something in the middle called tariffs. There was one pretty large bout of volatility in the mid-year, and credit did better through that than equities. And then, of course, we had all the technology stuff take off, and people forget that there was volatility. So I think if you consider that volatility is certainly a possibility for 2026, I think credit can be quite competitive with equities.
Yeah, the tariff tantrum, it certainly feels like a long time ago. So when you're talking about credit returns in 2026, I assume you're talking about public credit. How does private credit wrap into that conversation around returns?
Yeah, well, I think quite simply the private credit trade, the alpha is over in private credit. It was a tremendous opportunity in 2020 during the pandemic when public markets were shut down and private credit was the only source of capital. But now we're seeing the returns converge. So I don't think there really is any advantage in private credit. You could actually argue that there's a pretty good chance that private credit does worse than public credit next year because of the low credit quality and concentration. And I'm generalizing, but most private credit portfolios are over 80% B- or below, and they're highly concentrated in sectors like technology. They can be as much as a third or more in the technology space. That is not analogous with the public markets that are broadly diversified, that are diversified not only by sector, but by rating cohort. And most, let's just take high yield. High yield is mostly double B. So you're comparing a double B index versus a B- index. Depending on your outlook for risk, they're going to perform very differently. I think our view here is that the weakest areas of credit, the lowest credit tiers, are the most exposed to losses or at least poor performance. And so under that scenario, the up in quality characteristic of the high yield index just looks a lot more attractive for similar yield.
Well, then I am curious. I mean, obviously, that's the existing portfolio out there. With regards to new issuance, do you also anticipate it will be much higher quality overall?
Well, it's hard to anticipate what will happen in the future. All I know is so far, high yield and investment grade credit have been improving in credit quality. And there hasn't been much in the way, well, triple Cs actually have been dropping in terms of issuance over time. They've been going to the private credit market. So what happens next year? I don't know. It is certainly possible that we see a re-emergence of lower quality credit in the high yield market. But it would take some time for it to deteriorate into looking something like private credit. I just don't anticipate that at all. And you're starting from such a high quality level that I don't think it's an issue really to consider right now. Maybe as we get into 2026 and into 2027 is when we start to worry about things. And I'd also just point out that for any sort of talk about bubbles and things like that, excesses build when you have a high degree of issuance and M&A transactions, and we haven't had that.
Right.
When I talk about issuance, I mean net new issuance. And so I think next year is the year, maybe be on watch, but nothing really alarming immediately as we end the year here.
All right, Robert, hope to pick up this conversation in the new year. Great to get some time with you. That is Robert Cohen. He is Director of Global Developed Credit over at Doubleline. Now, coming up, Strategy shares hitting their lowest level in more than a year as a plan to backstop Bitcoin-fueled weakness fails to excite investors. We'll unpack the move next. This is The Close on Bloomberg. Shares of Bitcoin treasury company Strategy hitting their lowest level in more than a year. The firm failing to calm investors with its newly established $1.4 billion reserve meant to backstop its dividends amid near-term crypto volatility. Joining us now is Bloomberg editorial executive editor Stacy-Marie Ishmael. So let's start with the basics.
Near-term volatility.
Near-term volatility, yes.
Right. I'll keep my mouth shut.
A dollar reserve, what does that mean in the context of a digital asset treasury company?
Well, when Trump was inaugurated, one of the big campaign promises to the crypto universe was that the US would create a strategic Bitcoin reserve. And so, you know, there's kind of this impression of like a play on that idea, which is the idea of what Strategy shareholders want is a commitment that, you know, Michael Saylor and co will be able to meet their dividend obligations to those shareholders or any interest payments that they might have coming up over the next few years. Hence this idea of a dollar reserve, which is we will have good old greenbacks in that eventuality.
What does this morph into? I mean, assuming that we don't see like a massive rebound in Bitcoin back up, you know, over 100K, does this create a situation where he's going to either have to get rid of some assets in order to fund this, or does he basically just become, instead of a Bitcoin reserve, a dollar treasury reserve?
Just like a boring corporate treasury.
Yeah.
In terms of their loan obligations, you know, Strategy has at least a 3 or 4 year runway before it has to meet any kinds of commitments or covenants. They've been pretty conservative, actually, in how they've designed their debt-related capital structure. The dividend payments are sort of a more imminent concern. Like, one of the other things that we've seen analysts, including folks at JP Morgan, write about is this idea that all digital asset treasuries might be under pressure because they could get excluded from indices, which would, you know, certainly affect like passive flows from major ETF providers, et cetera. And that, I think, to your point, Romain, that's really what we're paying attention to, right? Like, because Bitcoin volatility, like Bitcoin's going to go up and down.
Yeah.
But January 15th is going to be the next big, you know, reckoning moment for Strategy, because that's when they're going to find out if they're going to get removed from certain indices or not.
Right. That's the MSCI decision. Talk to us a little bit, though, about comments that we heard from Strategy's CEO, who is not Michael Saylor, suggesting that, I mean, this could evolve into a situation, to Romain's point, where they might sell some Bitcoin.
Yeah, and, you know, they were very careful to say, like, if we have no other options, if we don't have access to capital at that point, we will consider selling Bitcoin. I think it's not so much the fact that they would, because they have in the past. It's more that, you know, Michael Saylor and Strategy are perceived as like the ultimate, to use the parlance, like diamond hands in the business. Like they hodl even when the going gets tough. And so it was a real dent to sentiment, right? This idea that a known Bitcoin evangelist is willing to say that market circumstances might dictate a sale of this, you know, most revered asset class.
Yeah, all right. And it also raises a lot of questions, too. When you have this big drop, usually you had all these folks coming in to buy those dips, and maybe they're not in the capacity to do it. Stacy-Marie Ishmael, our Bloomberg editorial executive editor. Meanwhile, I want to take a quick look on the after-hours trade. Taking a look at shares of Instacart. Those shares are plunging here in the after-hours trade. This after the information reported that Amazon is planning a new ultra-fast, in its word, U.S. grocery delivery business. And iRobot, which remember had that tie-up with Amazon that never did come to fruition last year. That company now saying that its exploration of strategic alternatives, at least for right now, has led it nowhere. Those shares down 9%. This is the close. All right, we've been talking a lot about the health of the consumer as the holiday shopping season is underway. And then there's a company called StockX out there, a resale platform logging tens of millions in sales this Cyber weekend. Several products breaking single-day sales records on Black Friday, with buyers clamoring for specific brands in addition to footwear, apparel, and collectibles, including collectibles like Labubus and Pokemon. Joining us right now is the CEO of StockX, Greg Schwartz. And Greg, I was trolling through your site over the weekend, not necessarily for gifting, but for myself. But I am curious as to sort of what people were buying. What gave you a sense here of kind of where the trend is, or at least in the moment, this holiday season?
Yeah, absolutely. Well, thanks for having me on. First of all, it was a really strong start to the holiday shopping season. Starting on Black Friday, we saw a surge of order volume, up 200% week over week. During peak Black Friday trading hours, nearly 2 trades a second on our platform. Gross merchandise value up year over year, AOV up year over year, average order value. And one of the hottest products, it was actually our biggest release ever on Black Friday, was the release of the Nike Air Jordan 4 Black Hat. That product set record sales volume and was one of our top 5 biggest releases in StockX history. So Nike definitely showing a strong comeback to kick off the holiday shopping season for us.
I am curious, Greg. I know you're just kind of like the conduit to connect the buyers and sellers, but a big part of the holiday shopping season, of course, is fulfillment. Obviously, Amazon probably does that better than no one out there. I am curious as to how you prepared for this season to make sure that when people buy something, they get it and they get it on time.
Yeah, we have a logistics and verification network that spans the globe. We have customers in more than 200 countries and territories around the world. And over the last couple of years, we've really doubled down on our efforts to drive faster fulfillment. We actually just recently rolled out next day shipping. These are things that are standard in traditional e-commerce, but a lot trickier when you have a two-sided marketplace. We're connecting thousands of buyers and sellers across, hundreds of thousands of buyers and sellers across global trade lanes. And so for us to be able to drive faster fulfillment each year is something we focus on. And it's really driven by a great team that's helping get products verified out to customers as quickly as possible, since all these orders are passing through our verification centers or shipping from a StockX verified seller.
Well, when you think about this past weekend, a stat that caught my eye in terms of what you saw on StockX was that roughly 25% of the sneakers that were sold during Black Friday were actually priced below retail. Give us a little bit of context there, how that 25% figure stacks up to what it typically looks like, and also what that signals to you.
Yeah, there's definitely going to be an appetite for that high demand, higher price point item like the Jordan 4 Black Hats that I mentioned earlier. But there's also this price conscious, value focused buyer that drove that 25% of the volume that was at or below retail. And I think that's just the power of a marketplace where there's going to be, items that are available in more abundance. And a marketplace like StockX is based on stock market dynamics to have a true market-based pricing. When there's more supply for an item, it's going to drive product prices down. And that's what we see. And it's not just Nike, and it's even not just sneakers. What we're seeing is Fear of God hoodies. We're seeing collectible items like Labubu, a number of different items from Pop Mart. And so you're going to have both ends of the spectrum, but absolutely a value-conscious buyer that showed up during this Black Friday shopping weekend as well.
Interesting. It makes me think a little bit of the Real, for example, when you talk about that sort of category. But I want to talk about a recent announcement from about mid-November that you're actually pairing up with prediction market Kalshi as a way to bet on resale prices of sneakers and some of the other items that you mentioned. So Kalshi, it's going to use StockX data to create so-called event contracts tied to some of these items. Greg, I just wonder how this one came together, because I'm not sure how many people saw this coming.
The genesis of StockX was really this idea that we could build a stock market for consumer goods. And so the entire origin of this company was based on using stock market tenants to help with transparency and really thinking about products that we trade on StockX, sneakers, apparel, collectibles, as really an alternative asset class. And so when we saw what Kalshi was doing, we got really excited about not just looking at prediction markets for elections or for sports betting, but what we did with Kalshi is we said, let's for the first time create prediction markets tied to certain price points around consumer goods. In this case, we looked at what would the hottest brand would be outside of Nike and Adidas on Black Friday, and the Kalshi prediction market correctly predicted that it would be ASICS, which had a record Black Friday on StockX. So we're really excited about this trend. We think it's a great combination, a great win-win for us and for the customer.
What's the win for you? I mean, is it financial, or is it just the attention that it brings to StockX?
we love focusing on fueling our customers' passion for the products they love. In this case, our market data is powering these Kalshi markets. And so if we can partner with a company that's providing a better way to engage, to think about, to play with different pricing dynamics that trade on StockX, that's an absolute win. We love thinking about how are we driving more engagement and providing more market insights, more knowledge for the customer.
All right, Greg, really appreciate your time. That is StockX CEO Greg Schwartz. Meanwhile, let's take a look at some of the notable after-hours movers. We did get some earnings at the top of the 4 p.m. hour. You can take a look at MongoDB shares, absolutely flying right now, remain up about 16%. They did lift their 4Q revenue forecast. That beat estimates, and the third quarter looked pretty good as well.
Yeah, and then take a look at Credo. We don't talk about this company much. They kind of make a lot of the components that go in to the broader internet space here. So kind of the unsexy part of it, but nothing unsexy about that move in prices, up about 15%. The company basically posting a beat and raise quarter, including the guidance, so was huge. They're saying 3Q revenue, their fiscal 3Q, a range of 335 to 345. The street was only looking for about 248, so about 30% higher than what the street was looking for.
Yeah, not bad. Credo shares up about 14.5%. This is the close.
The holiday shopping season is here and the stakes are high. Inflation, tariff pressures front of mind for consumers. I recently had a chance to catch up with the CEOs of Bloomingdale's and Burberry to see how they plan to weather this holiday season and what kind of consumer trends they're seeing.
Tis the season for holiday shopping, and despite U.S. inflation holding above historical averages for 4 years, and tariff tumult upending global supply chains for the past 5, the CEO of Bloomingdale's, he says consumers are ready to spend.
Actually cautiously optimistic. The trend over the past few months has been amazing at Bloomingdale's. We feel pretty strong about our customers' feedbacks, about our partner feedback, about the current trend that we're experiencing. And we're building such a great event for this holiday season that we're convinced that it will resonate very, very well with the customer.
And he's not kidding. Bloomingdale's is betting big on the holiday season. From personalized stockings to a Labubu tree and even a visit from a very familiar face. All in an effort to reinvigorate the department store shopping experience with emphasis on experience.
This is what we're refocusing on right now, is bringing experiences. Not only great products, but really bringing experiences that create the conditions of relationship. People want to connect, and we want them to connect at Bloomingdale's.
The Bloomingdale's flagship store on the east side of Manhattan has for decades been one of the crown jewels of New York City retail. But behind that grand facade was a company struggling to adapt to the times. Now, after years of sales declines, Bloomingdale's, a division of parent company Macy's, has found its stride, posting 4 consecutive quarters of same-store sales growth heading into this holiday season. And Bloomingdale's has reason to be bullish. The National Retail Federation estimates that 44% of consumers will do their holiday shopping at department stores this year. And Olivier Bryon, he's confident it will extend his company's rebound.
It's really about rebuilding the next golden age of Bloomingdale's. We heard a lot about Bloomingdale's in the 70s, in the 80s, where it was really the place to go. And actually, right now what we're trying to build is really recreating this destination, Bloomingdale's. And we're an icon, but we have to reinvent ourselves. It's also what Josh is doing with Burberry. This is what we're aiming to do at Bloomingdale's, with one key focus is actually bringing back customer experience, customer delight in our stores, and really based on building relationship, connections, etc. This is what is making us different.
The New York retail giant joining forces with the iconic brand and plaid, a relationship that goes back decades.
This is a relationship that Burberry and Bloomingdale's have had for over 70 years. So it's the perfect place to bring our timeless British luxury brand expression to all of Burberry customers and all of Bloomingdale's customers, and frankly, to all of New York City.
To celebrate that partnership in the spirit of the holiday season, Bloomingdale's has literally wrapped their flagship store in a giant Burberry scarf.
It was a little bit emotional, I have to say, seeing this uniquely British, uniquely Burberry, uniquely Bloomingdale's story come to life on the streets of New York City. There's only one New York. We are really thrilled to open our arms and wrap a scarf around New York City and bring a little bit of warmth and joy for this holiday season.
And since Joshua Schulman took over the helm of Burberry in July 2024, shares of the London-based brand, well, they've rallied 50% as the American-born CEO leans into the brand's Britishness.
There are many luxury brands that have wonderful, beautiful heritages, and they celebrate their heritage, whether it's Italian or French. But Burberry is unique because we are the only luxury brand of scale that has a uniquely British heritage.
Burberry, remaining true to its roots, is highlighting the products that cemented its status in the luxury space, while also branching into new directions.
Everyone knows and loves a Burberry scarf, which is the perfect gift for anyone in the family, around $520. But we have a range of products. You know, you can buy a candle for $130 to one of our iconic Made in England trench coats for $3,000. Burberry has always been at its best when it is a luxury brand with broad universal appeal. What we love about Bloomingdale's is they really share our values. And this is a brand that also has broad universal appeal.
A recent report by JP Morgan shows that consumer demand for luxury goods in the U.S. is largely held up despite the economic headwinds. The S&P's Global Luxury Index, which tracks 80 of the biggest names in that space, including Burberry, Prada, Dior, LVMH, that is showing no sign of slowing down.
The momentum that we're seeing didn't start for holiday. It started, months and years ago, and we just keep the pace right now. So we have new events, we have new marketing activation that are coming, we have new brands coming in the store right now, we have new ideas. So I think it's just a kickoff of what's coming.
And though Bloomingdale's has only just unveiled their 2025 holiday display, they're already looking ahead toward the future.
We already know what's going to happen in 2026. We're already working on what's going to happen in 2027.
Conversations we had with the CEOs of Bloomingdale's and the CEO of Burberry here at the start of the holiday shopping season. Katie Greifel, everybody's already trying to look at the numbers for Black Friday and Cyber Monday. But one that I thought was interesting, Salesforce came out with data. And I thought this was interesting.
Tell me.
Sales growth, and this is specifically with online sales growth, was higher in Europe, about double the pace in Europe than it was in the U.S., about 8%, which is curious because traditionally the Europeans don't sort of celebrate, if you will, Black Friday the way we do here. And I don't know if that's an ominous sign. I mean, they're tying it to the idea of the tariffs are kind of going to hamstring some of the sales growth potentially that we would have had.
Or maybe the e-commerce wave has finally made its way to Europe. Who really knows? But that is a very interesting stat. Thank you for bringing it to me.
It is. Anything I can do for you.
Yeah. All right. Well, still ahead, we're going to talk a little bit about AI. McKinsey out with a report on AI and the workforce. We'll discuss with Madgavkar. She is partner at the McKinsey Global Institute. That conversation up next. This is Bloomberg.
Some breaking news involving those potentially sweetened bids for Warner Brothers Discovery. Bloomberg reporters have learned, according to people familiar with this situation, that Netflix has made a mostly cash offer to Warner Brothers. Now, it's not really clear exactly what level that is, but again, this would be the second round of bidding. Netflix had apparently already put a bid on the table about a week and a half ago. Warner Brothers came back and said that Netflix, along with Comcast and Paramount Skydance, needed to sweeten that just a bit. Apparently, Netflix has done that, and more importantly, it'll be a cash offer. This is also a binding offer, too, so it's on the table right now, and if for some reason Warner Brothers was willing to accept it, this would be the deal that, in theory, would go through.
All right, we will continue to follow that story. Netflix flexing its muscles with that cash offer. You can see that Warner Brothers Discovery shares deciding what to do. But let's turn a little bit more to tech and talk specifically about NVIDIA investing a $2 billion stake in chip design software maker Synopsys. Not the only tech name making headlines. You also have OpenAI taking an ownership stake in Thrive Holdings in a bid to speed up business adoption of AI. Now, our next guest has a recent report out on how AI is reshaping the workforce, writing, quote, AI-powered automation could unlock $2.9 trillion of economic value in the United States by 2030. Joining us now is Madgavkar. She is partner at the McKinsey Global Institute. Great to have you on set with us. So talk us through, what this would mean for the American workforce, because a lot of people hear automation and they think job losses.
I think there will be very profound changes in
what work feels like and what the workplace feels like as a result of AI. Based on currently proven technologies, we think that more than half of all work hours in the US economy could get theoretically automated. The technology has the capabilities, AI-powered agents and robots. Now, not all of that will happen overnight. There is a pace of adoption that one can expect. But certainly the workplace will feel very different because it'll feel more like a partnership or a collaboration where every worker works with an AI tool, almost like a co-worker, doing all sorts of work in collaboration with technology.
Well, that is a stunning stat that more than half of current U.S. work hours could be automated. Are there any particular industries where automation would make the most sense, for example?
The effects of automation will be across industries. And we see that already in the US, cognitive work, which is work that involves sort of information processing and those kinds of capabilities, take up the bulk of US work hours already, whereas physical work is a smaller share. Now, automation is going to impact both kinds of work. But as a result, we would see AI-powered agents that can operate in the digital world on cognitive tasks, taking up a much larger share, and that's across industries, including the retail industry, of course.
Well, when we start to see these big numbers, though, the percentage of sort of workers, or I said work hours, I should say, that some of these AI agents will be able to take over, why should that not lead to job losses long term?
Well, that's a great question, and that's really because there are a couple of reasons, right? One fundamental reason is that there are many kinds of work and work activities that are still beyond the capacity of technology to perform. Many social and emotional capabilities, just interacting with people, troubleshooting, conflict resolution, things like that are things that human beings do best. And then even in work that AI will be able to do, we're seeing from live deployments that the role of the human worker remains vital in guiding the AI, framing the right questions and tasks, looking at outputs and validating, checking them, exercising human judgment in terms of which of the options actually make sense given the context, which only the human worker knows best. So for all of these reasons, and then there's also the fact that work also changes. New kinds of possibilities emerge, new products and services.
What's
and so
the
on.
pace of that change, though? Because it feels like it's starting to accelerate. I mean, I know everyone says the AI future is already here, but you even take a look at some of these new AI models, the ones that the image models that create videos and imaging, to see the progress from even a year ago of what they were able to do, which was kind of janky, and to see it now, where it almost seems there's no way an average person would even be able to detect that it was an AI video or image. Is that the pace of change that we should get used to?
There's a pace of change in the technology advancement, which is very much like what you described. But what's more important for the economy and the workforce is the pace of adoption. So the 57% of work hours that could be automated are what technologies allow. That doesn't mean on the ground it actually happens immediately. That's a function of the cost benefit, the challenges that businesses face in creating and implementing solutions, the culture that needs to change, workers that need to get retrained in doing work a new way. So all of that does mean that actual adoption on the ground is, well, lower than potential, but accelerating very fast. And there's an almost $3 trillion economic size of the prize if we actually drive up adoption by 2030 across the workforce.
All right, interesting report. I got to get you back for a longer conversation sometime. Anu Madgavkar, partner at the McKinsey Global Institute. Meanwhile, we do want to get back to that breaking news with regards to Warner Brothers Discovery. Netflix apparently submitting a mostly cash offer, a sweetened bid here to buy that company. Chris Palmeri, our man in Los Angeles, joins us right now. And Chris, I mean, what do we know? I mean, do we have any sense of what they actually bid? I know the last couple of weeks, the reporting was that most of the bids were around that $23.50 mark, and apparently Zaslav and Warner Brothers wanted to see something a little bit more. What do we know?
Yeah, we definitely are hearing that they're edging a little bit closer to that $30 number, depending on how you value things. Big surprise here that we reported was that the Netflix offer is mostly cash, because Netflix's stock has been doing terrific in recent years. A lot of people expected them to use that as the currency. And apparently they feel more confident paying cash, and in fact are in talks to raise tens of billions of dollars as a bridge loan to help pay for this.
And it's interesting, when it comes to Netflix, the understanding is that they're only interested in part of the company here, specifically the studios and HBO Max, the streaming service there. What would that mean for the cable channels?
Well, then, in the case of Comcast and Netflix, which both of them are only interested in the streaming and the studios, Warner Brothers would continue with plans to spin off its cable channels. So that's CNN, TNT, and all of those businesses would still go off to current shareholders.
So, and just real quickly, Chris, when we talk about this idea, are we anticipating that we'll also see something, a sweetened bid from the other players in this, the Comcast, the Paramounts, et cetera?
Yes, we know that Netflix submitted one today, the second round, but we are expecting the others. And we're also hearing that a deal could come in just days, really, if Warner Brothers board signs off.
All right, Chris Palmeri, our man out there in Los Angeles. We should point out, not a whole lot of movement in the shares. Warner Brothers Discovery shares have been pinned right around $24 for the last few sessions here. It'll be interesting to see if we can get some more details, Katie, on exactly what that sweetening is.
Yeah, and to your point, it's going to be interesting to see what Paramount, what Comcast come back with. It seems like, again, talking to Jason Bazinet, that it seems like it's Paramount that would take it here, that would have the highest likelihood, but Netflix coming out with this cash offer.
All right, we'll try to get you some more details on that. Meanwhile, a lot going on in Washington. The Balance of Power team, they're coming up at the top of the hour right here on Bloomberg.